So now let's take a look at the bigger picture with Russell Stone. He's the CEO and owner of Scranton Financial. Russell, thank you so much for joining us. Let's start first with Powell's speech today. What were your thoughts on his more hawkish tone?
It was predictable that he was going to have to get more hawkish for a number of reasons, Renita. The Fed has this illusion that they can control the interest rates under any environment, and that's not true. When fear starts to enter into the narrative, then the fear of default takes over, and the interest rates become much more unpredictable. And my prediction is that interest rates are going to trend up fairly aggressively in the coming weeks and months, and maybe even for the balance of this year, only because of fear of default. The credit bubble is large, it's contracted. The Fed is pulling money back into the out of the M2 money supply. So it doesn't surprise me at all that he's getting more hawkish, because I think he's being forced to become more hawkish.
Exactly. And so at some point, the data is going to have to meet up with that. Maybe, maybe not. We've definitely seen a mix lately. But what kind of impact could we expect from interest rates continuing to go up? Let's talk first about the consumer, and then we'll talk about what may happen with stocks.
Okay. Well, the consumer, it's, depends on what side of the equation you're on. If you're a saver and you don't have any debt, then your interest rates on your CDs are going up, and money market accounts and savings accounts, traditional fixed annuity, stuff like that, those interest rates are going up. The dividends on your stocks might be going down. All depends on the profit margins. But the consumer is going to be impacted negatively when it comes to the cost of things. So if you're maxing out your credit cards, or if you have high consumer debt, the rise in interest rates is devastating. And on top of that, throw in inflation. That is a 1-2 punch that is going to impact the economy. It already is.
So how are you advising people to prepare for something like this?
Well, it's, let me put this out here first. There is good news coming. The problem is it's coming. It's not here yet. We have to go through some hard times before we get to the rebalancing of the equity markets and the stock market and the economy as a whole. But right now, the overwhelming economies throughout the world actually are running on debt. They're not running on value. They're not running on gold, silver. The currency system is based on a petrodollar right now that is backed by OPEC oil and $32 trillion of debt. So there's lots of problems surrounding that arena. But at the end of the day, we are going to have to just attack the problem, which is the monetary policy, the massive amount of debt. The rise in interest rates are going to have a big impact on the economy. They already are, like I said, housing market, the car market. Big tech has already started their layoffs. So.
Yeah. No, I was agreeing with you. You're absolutely right. And we're seeing even more layoffs happening with big tech. Doing a second round, we got a report about Meta possibly doing the same thing again.
Yeah, absolutely. And think about it. These are the jobs that pay benefits. These are the jobs that provide excess money above and beyond the inflation. So a lot of people that are struggling, they're barely making ends meet, and then they have this big inflation bill to pay on top of it. So that's struggling. We haven't seen the full impact of that yet. It's not showing up in the numbers as we would like, because a lot of people are working 2 jobs, not 1. So the jobs numbers are skewed because so many people are out there not making their ends meet on 1 job, so they have to go out there and supplement it with a second job, part-time or full-time. So those aren't the type of dynamics that you would be overly excited about the stock market. And when you say, what are you doing with your clients, Russ? Well, I'm telling them pay off short-term debt. I'm telling them to buy precious metals, invest in money market accounts that only use treasury bills as the underlying asset. And just get ready, be patient, get ready for the opportunity at the bottom of all this. People should get excited. There's going to be some great opportunities at the bottom, but we're not nowhere near it yet. We have at least a year to go before we see the bottom of this market. The bottom of deflation is a word that's going to pop up a lot.
You're absolutely right. Briefly, can you tell us a couple of industries that could be affected the most by this time?
In a negative way, obviously retail. Obviously anything that is a want is going to be more resilient than something Well, let me rephrase that. Anything that is a want is going to be negatively impacted more so than a need. So if I'm going to invest money, I'm going to focus on the need side of the economy, not on the want side. You know, luxury cars, I don't think are going to be doing that well. RVs are struggling right now. The sales of RVs are way down. High-end cars are way down. Luxury items are way down. But if you look on the side of the needs, you know, food's always going to be around. Alcohol, cigarettes, all the sin stuff is going to be there and still doing fairly well against the tide. Defensive stocks are always there. Utilities, anything military oftentimes is resilient against deflation.
Yes.
But the overriding theme is deflation, right? The demand is going to go down. There is a scenario where prices go down, interest rates go up, and the stock market comes down.
Right.
And that's called the 1930s.
Ha! Do we want to live there again? I don't think so. Russell Stone, thank you so much for joining us. He's the owner of Scranton Financial. I appreciate you spending the time here.